We have with us Shweta Rajani, Mutual Fund Head at Anand Rathi Wealth, joining in to decode and to take some questions and solve a lot of those doubts that exist for our viewers. Welcome, Shweta. Good to have you with us. We'll start off with the basics, Shweta. What exactly are debt funds and how do they generate returns for investors?
Good morning, Sakshi. Yes, like you said, a debt fund is a universe in itself. Now, basically, what a debt fund is, it's where multiple investors come together, pool in the money, and then you have an expert called the fund manager who's deciding where the money has to get invested. Except that here he's deciding which company's debt can you participate in. So just like if you're participating in an FD, you're giving money to a bank as a deposit. In a debt fund, to put it in very simple terms, the fund manager is deciding which either it's the government paper, give money, lend money to the government, or to corporates, right? So they're buying FDs or debentures in very simple terms of different companies of different credit profiles. It could be a bank certificate of deposit, it could be a corporate treasury who they're giving money to. So yes, it's buying debt papers of different maturities of either government or corporates, private, public, all put together. That's a debt fund in very simple terms.
Okay, give us an understanding of what are the different types now of debt funds that investors should know, and how should an investor differentiate between these types of debt forms?
Yes, so this is very important because you have, as per SEBI, 16 different categories of debt funds, but it's not as complex as it may sound. Okay, the good part is these debt funds are broken up into categories according to the tenor or the investment horizon that you may have. So for example, if you have money which has to be parked for, let's say, 3 months, 3 to 4 months, you can either participate in an overnight fund where, the lending happens for one night, or it could be a liquid fund, or it could be an ultra short duration fund. If you have monies for, let's say, 6 months to a year, you can go in for a low duration money market or a short term fund. If you have monies for, let's say, 1 to 3 years, then you can again park it in a medium duration fund or medium to long duration fund. If you have monies which are, let's say, more than 3 years, then you have categories of long duration, you have dynamic bond, you have gilt, which can be, gilt is nothing but investing 100% in GSEC. Here you could have a 10-year standard GSEC, you could have a GSEC which has different maturities. So these are, broadly the categories. It's very important to understand what's your investment horizon, what's your credit taking ability, because you also have categories like banking and PSU, corporate, debt fund, and credit risk fund, which would be taking differentiated credit.
I'm sure this definitely clears a lot of air, and you've clearly categorized as to, and in terms of the duration, what kind of funds should you target for your portfolios. But, where the confusion usually happens is when people have to approach debt funds for a shorter duration, less than 1 year, few months for instance, and there you've talked about liquid, ultra short duration funds as well. So what is the difference between these, and how should one be taking a decision there?
Yes. So, see here again, they have clear mandates of what kind of papers they can hold and what maturity papers. So, if you have, let's say, money which has to be parked for 7 days, then overnight is the best category for you. But let's say you have monies which you want to invest for 2 to 3 months, then liquid fund is the category you should opt for because they invest in papers which mature within 91 days.
Okay.
Or if you have monies which could be 3 to 4 days, then ultra short is your category.
That's 3 to 4 days itself.
Ultra short is 3 to 4 months.
3 to 4
Overnight
months.
will be for
Ultra
3 to 4
short.
days.
Okay. Understood. And for 6 months to a year, what kind of categories would you advise?
So here you have 3 categories from which you can choose. You have low duration, money market, and short duration. Short duration generally can buy 1 to 3 years. So low duration or money market.
Low duration or money market, fair point. Now, let's also cater to something which is primarily, and then we will go deeper into the other categories as well. Usually, people think that debt funds have no risk and therefore one should really look at it. For those people who look at equity funds, they think that there is a certain amount of risk that comes in it because of its association with the stock market's volatility. But in debt funds, there is this entire myth that goes around that there is no risk absolutely at all. But is there something which exists which has no risk absolutely, and what would you advise in terms of debt funds? What is the kind of risk that one should be aware of?
Yes. So, see, there is no investment which does not have a risk. Even if you're investing in a bank FD, there is a credit risk if something goes wrong with the bank. So, in debt funds, there are primarily three risks that you have to be cautious of. One is the interest rate risk, which means if the interest rate goes up, the price of your debt fund can fall. Liquidity risk is where if a fund has invested in low credit papers, they will not be able to liquidate it easily. Third, I would say, is the credit risk. What if the issuer or the company where you've invested defaults? So these are the three risks. However, let me also tell you that if you are investing in the categories which are shorter duration categories, all the three risks are very well taken care of. So only when you're investing in something like a credit risk category, you need to be a little wary of your credit and the liquidity risk. So yeah, but these are the three risks keep in mind when you're investing.
Okay, let's now try and understand the difference between debt mutual funds and something like what you pointed out, GSECs, or maybe even corporate bonds as well. Where do debt mutual fund investors or the fund managers put in the money vis-a-vis what is already existing as government bonds or government papers, T-bill securities, or corporate bonds? So what is the difference there? How should one go about understanding?
Yeah. So one is you can directly invest in these papers. You can pick a corporate, buy the debenture, invest in the government bond on your own. In a debt fund, the fund manager is picking and choosing where to invest. The advantage of doing it through a debt fund is liquidity. You'll get your money within a day. You don't have to bother about going to the market and liquidating your paper if something goes wrong. Second is diversification, because if you have, let's say, 1 lakh, you may end up buying one or two papers, corporate papers, but with that same 1 lakh invested in a mutual fund, you can get access to 50 papers. So diversification, and the credit is evaluated by the fund manager. So there's somebody who's doing the entire due diligence for you. So therefore, debt fund becomes a better option.
Okay, therefore viewers, try and understand, if you are looking at it for the first time, then look at it by way of trusting a fund manager with the expertise that they have to be able to give you more diversified way of investing in these corporate or government papers, yet at the same time reducing a lot of your risk because of the diversification, and taking that decision on your behalf as well, rather than giving you that limited choice of going ahead and choosing that I want to go for this corporate bond or I want to go for that government fund as well. So those are the things, and we will also come to understanding, in case you still want to go ahead and choose for yourselves, what are the things that you should keep in your mind as well. So let's try and understand first about debt funds, the kind of returns that we get. We've understood what are the categories, what are the types of debt funds that come in. We've also understood why debt mutual funds are better off, because you're giving your money in the hands of experienced fund managers there. But what are the kind of returns one can expect vis-a-vis something like you alluded to, a fixed deposit, which is largely been seen as the biggest form of debt investment that Indians are used to of doing since many years. So if we want them to shift out their money from fixed deposits to debt funds, having that safety of the debt or the hedge of the debt in their portfolios, yet looking at better returns, can they expect better returns in debt funds?
Yes, absolutely. So like I said, there are different categories of funds. Now, if you are, I'm just, going to talk about an FD. If you're investing today, we end up giving you a 6.5% of an interest rate. Yeah. In a debt fund, let's say you're investing in a GSEC oriented fund, a fund which is investing 100% in GSEC, you may end up getting a 6.5 to 6.75% of return. If you're investing in a corporate bond, where corporate bond fund, where 80% of the money is in AAA rated corporate bonds, there you may end up getting a 7.5. A credit risk fund may end up giving you somewhere closer to an 8% of a net yield. And then you have on the passive side, again, you have target maturity funds, which are also investing in government papers. So there again, you may end up getting between 6.5, 7. Slightly better than what the FD can offer to you, but it gives you the benefit of liquidity at any given point of time. So you don't have to pay a penalty like you would in an FD. And the taxation is deferred taxation, because while it's charged at the slab rate, you pay only when you redeem. Unlike when if in an FD, you have to pay taxes on an accrual basis every year. So therefore, if you look at it from the benefits, not just the return, but the other benefits, you may be better off in a debt fund than an FD.
Let's also try and understand the taxation part. That's also very important. Now, usually we are seeing off late over the last couple of years, people are getting more aware that while they are investing in fixed deposits, the kind of returns they are expecting is around 6.5%. That's barely beating inflation, and yet at the same time, the tax component is also pretty high, because FDs are taxed as per your own salary tax slabs, and for those especially in the higher tax slabs of above 30%, they find it to be absolutely something which is not really giving them the kind of returns that they would have expected a debt component to give to their portfolios. So how is debt fund different in that aspect, if you could explain that?
Absolutely. So, see, both debt funds and FDs, the taxation is as per the slab rate. Where the difference comes in, like I said, your FD interest is comes under the head of income from other sources, and therefore it's interest income, which you cannot defer. If you are following the accrual system, then every year on whatever interest is accrued, you will end up paying the slab on that. When you earn income from the mutual funds, they will come under the head of capital gains charged at the slab rate. You will pay only when you redeem. So if you redeem
Yeah.
after 5 years, you'll pay it then. So the deferring of the tax also benefits you.
Absolutely. So that's a very important point, viewers, that you must remember. What's the difference between the taxable aspect as well? Let's now try and decode for our viewers. If somebody wants to go ahead and look at these funds, you did tell us that one is a very important aspect in terms of duration that they should be looking at, which funds are better suited for their portfolios. What are the other things that they should know? When we look at equity mutual funds, we tell them to look at NAVs. There are several other aspects as well. What do you tell them to really look at while identifying the right set of debt funds for themselves?
Absolutely. So, three, four important factors that you should check for, and this is available in any fact sheet of a debt fund. One is match your investment horizon with the duration of the fund. So, you will see average maturity and modified duration mentioned in the fact sheet. Technically, if you have 2 years in your hand for investing, look for a fund which also has a duration of around 2 years, somewhere closer to that, so that you are reducing the interest rate risk impact on the portfolio. Second, in debt funds, don't look at the past return. You will see a component over there mentioned as net yield, net YTM, yield to maturity. It is it's an indication of wherever the fund has invested, whatever papers, what is the kind of yield or the interest income they are getting. So that gives you a sense of what kind of a return you can expect from that debt fund. So compare your debt funds which have a higher net yield. Third, look at the credit breakup. The better the credit quality, then invest. And so all the three risks that we mentioned earlier are getting tracked, and then take your investment decision in a debt fund.
Okay, let's also try and understand what is the kind of impact that the changing interest rate scenario has on debt funds as well. We are currently in a long pause when it comes to RBI's focus on the interest rate policy, but everybody is looking at when could the current cycle reverse and we could start looking at a rate hike both globally and in domestic markets. There is a fear looking at the current economic scenario that the US Fed could soon start raising the rates, and that could also mean that the RBI could look at raising the rates as well. What will be the impact of such interest rate changing cycles on debt funds and our investments there?
Yes. So, it's important to understand the relation between the yields and the prices. Okay. In very simple terms, I'm going to take a minute to explain this. Let's say you bought a bond at 100 rupees, which was giving you a 7% interest rate. Now, if the same company issues for the same maturity another bond after a week where they are offering 7.5% interest rate, okay, the bond you hold when you got it at 100 rupees was giving you 7% interest, clearly will have less demand now in the market because a newer bond by the same company, same maturity is offering 0.5% more. So the price of your bond, which was quoting at 100, may fall to 99 rupees. That's the impact. As the interest rate goes on increasing, the price of the bond goes down. So that's the inverse relation. So if we get into a scenario where interest rate is rising, you could see the debt fund prices could also see a fall, or a return which is slightly lower than what you would have expected. Therefore, it becomes very important for you to match your investment horizon with the duration of the bond, because duration is an indication of the interest rate risk.
Okay, fair point. So I hope this point is also well noted there, viewers. Let's try and understand now who should really look at investing in debt funds. That's another very important question that our viewers should know to be able to decide whether debt funds are for them. Usually, there is a thought process that when you are younger and are able to take higher risks, you should have more exposure to equity. As and when you grow older, you need to have more certainty in terms of the kind of returns that you have, or more, less affect, your portfolio is less affected by any kind of market volatility, and that's when you should have higher component of debt. What do you usually advise as a thumb rule to all the clients who come to you to understand whether debt funds are meant for them or not?
Yes. See, the most important point here to understand is what is the return that you are wanting to achieve on your overall portfolio. What is that objective, the return target? And clearly, that has to be more than inflation. So, depending on what you're targeting, 10%, 12%, 14%, you will have to decide your asset allocation mix between equity and debt. Second becomes your investment horizon. Now, there is enough study which shows that ideally, if you have a 7 to 10 year horizon, then the probability of equity making you money goes significantly up. So the dependence on debt therefore comes down, because as time passes by, equity volatility reduces. So ideally, I would say if you are an individual who can take a little risk and you have 10 to 15 years in hand, then majority of your portion, it could be anywhere between 60 to 80% can be allocated to equity. The rest of it could be to debt, because debt is not helping you beat inflation. Debt is only giving you stability and helping you beat the initial volatility which you may have to face if you have equity in the portfolio. So, depending on your liquidity requirements, your time horizon for investment, you can go from anywhere between 20 to 40% of debt in the portfolio.
All right. Okay. I hope this there also has helped you out as well as to how much and at what stages for what duration that you should be really looking at debt funds in your overall investment basket as well. Now, give us also an understanding. Usually. There's also another myth or misconception when people go for equity mutual funds also, the beginning confusion happens is that people look at the brand value and then look at the choice of the mutual funds available there. What is the ideal way to approach debt funds in that fashion? Do you think the companies that give you, the mutual fund companies, the AMCs that provide you the debt funds are more important to be looked at, or is it the last 4 or 5 years of a return that one should be looking at? What are the things that you tell them to consider before picking out the right funds?
I think in that, where the fund house comes into picture is look at their credit history. If they've had lesser papers where they have invested and those defaulted, that's a good AMC to park your money with as far as debt is concerned. Don't look at past returns in debt. What matters is the yield to maturity that you see here, because the papers that you're holding today, what is it likely to give you in the future is what is important in debt, not what has already come in the past. So AMC track record in terms of their credit evaluation capability is definitely a must check, and the net yield and the current paper quality. These are the three things I would focus more on from an AMC standpoint, or the brand value evaluation standpoint.
Fantastic. Shweta, we are out of time here on this edition, but this begs, a much deeper understanding to our viewers. But I'm happy that at least this has given them a starting point to go ahead, do their own research of finding out what have they understood about debt funds and whether this is the right stage for them to look at certain kind of debt funds category to provide that stability to their overall portfolios as well. Viewers, in case you have any questions about debt funds, then you can send us on the number that's flashing on your screens. We'll be happy to get Shweta back on board to answer some of those questions on debt funds for you, to be able to help you understand better on how should you go forward with it. But always a pleasure. Shweta, thank you so much for taking the time out and of course explaining the entire debt funds categories to all our viewers. Thank you so much.